What if I told you 10,000 rupees could change your next 10 years? Not by luck, not by guessing, but by simple strategy. Most Indians invest blindly. They follow tips or copy what friends do and then wonder why nothing grows. This stops today. Before we begin, this video is for educational purposes only. I am not a SEBI-registered investment advisor. I am sharing knowledge, not personal financial advice. Markets carry risk. Returns are never guaranteed. Do your own research or consult a certified professional before investing. Your money, your responsibility. Let me say something clearly. 10,000 rupees is not small, but used incorrectly, it becomes invisible. Most people don't lose money in the market. They lose money before they even invest. Impulse decisions, random tips, friend recommendations, YouTube hype, no structure. 10,000 rupees without clarity is gambling. 10,000 rupees with allocation is strategy. Before you invest a single rupee, answer this. What is the purpose of this 10,000 rupees? Short-term, long-term, wealth creation, trading. If you don't define the mission, you will abandon the plan. Step 1. Stability check. Do you have emergency savings? At least 3 months expenses. If not, this 10,000 rupees goes there. Not exciting, but powerful, because survival comes before growth. Step 2. Debt check. Credit card at 30% interest, personal loan at 18%, then investing is not priority. Clearing high-interest debt is guaranteed return. No mutual fund beats 30% guaranteed savings. Now, assume you are stable, no bad debt. Now we build. 10,000 rupees must be divided. Never invest in one place. Diversification reduces emotional damage, and emotional control builds wealth. Simple structure. 5,000 rupees index fund, 3,000 rupees Flexi cap fund, 2,000 rupees gold ETF. Let me explain slowly. Index fund. It follows Nifty 50. Top companies of India. No guessing, no prediction. India grows, you grow. This is your foundation. Boring, stable, effective. Flexi cap fund. Gives growth boost. Large cap, mid cap, small cap mix. Slightly higher risk, higher long-term upside. Controlled exposure. Gold. Protection layer. When markets panic, gold holds value. Not for high returns, for balance. Now, listen carefully. Investing once changes nothing. Investing monthly changes everything. 10,000 rupees one time is action. 10,000 rupees every month is transformation. Let's calculate calmly. 10,000 rupees per month. 12% average annual return. 20 years. You invest 24 lakhs rupees. You may build close to 1 crore rupees. That is compounding, not magic, mathematics. But here is the real danger. You will see market fall 10%, maybe 20%. News will scream, fear will rise, and weak investors exit. Strong investors continue SIP. Wealth transfers from impatient to disciplined. Your edge is not intelligence, it is consistency. Automate SIP, remove emotion, stay invested. In part 2, we go deeper. Exact platforms, exact fund selection logic, risk control rules, and how beginners destroy returns without knowing. 10,000 rupees is enough if discipline is strong.
Imagine this. You have 10,000 rupees ready to invest. You open an app. You click Buy randomly. 1 month later, confusion. Your money sits, no growth, or worse, losses appear. All because you skipped structure. Today, we fix that. Step 1. Choose the right platform. There are dozens in India, but clarity matters. Look for these traits. 1. Low fees. 2. Easy SIP setup. 3. Direct plan options. 4. Transparent performance. Top options: Zerodha Coin, Grow, Paytm Money, Kuvera. Pick one. Don't juggle 5 apps. Focus breeds discipline. Step 2. Pick your funds. We talked about allocation. 5,000 rupees, index fund. 3,000 rupees, Flexi cap. 2,000 rupees, gold ETF. Let's make it concrete. Index fund examples. Nippon India Index Fund, Nifty 50. UTI Nifty Index Fund. ICICI Prudential Nifty 50 Index Fund. FlexiCap Fund examples. Axis FlexiCap Fund. Mirae Asset FlexiCap. Kotak FlexiCap. Gold ETF. Nippon Gold ETF. SBI Gold ETF. ICICI Gold ETF. Choose one fund per category. Less is more. Step 3. Automate SIP. 10,000 rupees per month. Divide automatically. No thinking. Emotion removed. Your portfolio grows silently. Discipline greater than luck. Step 4. Avoid beginner mistakes. 1. Chasing past performance. 2. Switching funds every month. 3. Timing the market. 4. Ignoring expense ratio. 5. Mixing debt and equity in panic. Mistakes kill compounding. Step 5. Track performance quarterly. No daily obsession. Market noise is distraction. Focus on progress, not price. Step 6. Tax awareness. Equity funds. Short-term, less than 1 year, 15% tax on gains. Long-term, greater than 1 year, 10% over 1 lakh rupees. Debt funds. Short-term, taxed as per income slab. Long-term, greater than 3 years, 20% with indexation. Gold ETF. Long-term, greater than 3 years, 20% with indexation. Tax efficiency compounds returns. Step 7. Rebalance yearly. Portfolio drifts naturally. Index grows fast. Gold stable. FlexiCap volatile. Adjust allocations once a year. Keep ratio close to 50% index, 30% FlexiCap, 20% gold. Discipline, consistency, patience. Step 8. Increase gradually. 10,000 rupees is starting point. Next month, 12,000 rupees. After 6 months, 15,000 rupees. Even small increases compound massively over 10 to 20 years. Step 9. Avoid advice overload. YouTube, friends, WhatsApp, everyone has an opinion. Follow your plan only. Consistency beats curiosity. Step 10. Focus on identity. You are an investor, not a consumer, not a tip follower. Investor mindset protects discipline. Investor mindset grows wealth. Here is the final truth. 10,000 rupees invested correctly is more than money. It builds habits. It builds identity. It builds freedom.
You've started investing. 10,000 rupees per month. Your SIP is running. But here is the truth. Most beginners stop here. They plateau. They get distracted. We are not beginners. We are builders. We scale. Step 1. Gradually increase investments. 10,000 rupees is the start. After 6 months, add 2,000 to 5,000 rupees. Next year, 20,000 rupees per month. Small, consistent increases compound massively. Discipline scales faster than luck. Step 2. Reinvest dividends. Mutual funds and ETFs pay dividends. Do not withdraw. Automatic reinvestment grows corpus exponentially. This is silent compounding. Step 3. Risk cycles awareness. Markets go up, markets go down.
correction of 10 to 15%, bear market of 20 to 25%. Do not panic. Wealth is built by riding cycles. Emotion destroys returns. Patience compounds. Step 4. Tax optimization. Long-term capital gains, equity, 10% above 1 lakh rupees. Index funds, direct plans reduce expense ratio. Debt funds, consider indexation. Gold ETFs, long-term holding minimizes tax. Tax efficiency increases real returns. Step 5. Portfolio rebalancing. Every 12 months, check allocations. 50% index, 30% Flexi cap, 20% gold. Markets shift ratios naturally. Rebalancing ensures risk stays controlled. Step 6. Diversify intelligently. Beyond the core 3 funds, consider international ETFs, hedge currency, global exposure. Debt mutual funds, stable fixed income portion. REITs or rental income, passive cash flow. Diversification protects and accelerates growth. Step 7. Emergency top-up. Life is unpredictable. Bonus, income spike. Add to emergency fund. Do not touch core investments. Safety first, growth next. Step 8. Automation mastery. SIP plus auto increase plus dividend reinvest plus rebalancing. Set reminders. Reduce thinking. Emotion removed. Consistency becomes unstoppable. Step 9. Avoid hot tips trap. Friends, WhatsApp groups, Telegram. Everyone has opinions. Follow your disciplined plan only. Results reward patience. Step 10. Mental model. Slow compounding. Investing is not exciting. It is slow, boring, predictable. But over 10 to 20 years, it beats luck, speculation, hype. Step 11. Mindset, identity scaling. You are an investor who builds wealth systematically, not a consumer, not a tip follower. Investor identity locks discipline. Identity greater than income. Step 12. Scaling mindset. Once 10,000 rupees per month is routine, increase to 25,000 rupees per month. After 5 years, 50,000 rupees per month. The absolute number doesn't matter. Consistency and compounding do. Step 13. Tracking and reflection. Quarterly review. One question. Am I following my plan? Not, how much did I make this month? Discipline compounds faster than profit chasing. Step 14. Avoid lifestyle inflation. Raise income. Do not raise expenses proportionately. Invest the difference. This is how 10,000 rupees turns into 1 crore rupees over 20 years. Step 15. Final formula. Emergency fund, untouched. Debt-free status, maintained. SIP, automated. Reinvest dividends. Rebalance yearly. Increase gradually. Avoid hype. Track discipline. Follow this. Time plus discipline plus identity equals financial freedom. You started with 10,000 rupees. You built habits. You built identity. In 10 to 20 years, your future self thanks you. Freedom is silent. Wealth is silent. Discipline is loud. This is your path to financial dominance. Consistency wins. Identity locks it permanently. And now, you are unstoppable.